Good morning, everybody. My name is Achille. I am the state chapter president of NACVA for Maryland and Washington, D.C. Welcome to this webinar. We are very honored to be sponsoring and moderating this event today. So before going further, I'd like to thank the organizers of this webinar, Vadim Ronzes of Rosen, Saperstein and Freelander LLC, Nick Horan and Genevieve Kurtz of Nevin and Associates. For this second session of a three-part finance webinar series titled The Bottom Line, Navigating the Impacts of COVID-19, we're going to talk about wealth planning during tumultuous times. RS&F has partnered with the accounting firm Steen, Sperling, Burnett, Jong, Driscoll, and the Maryland and Washington, D.C. chapter of National Association of Certified Valuators and Analysts to uncover wealth planning strategies, best practices, and discuss the challenges brought on by COVID-19. So this is going to be a 1-hour webinar with no CPE. So without any further ado, let me introduce to you the two panelists of this discussion today. First, David Jong. David, good morning.
Good morning, Achille. I am a practicing attorney, although I'm also a CPA credentialed in business valuation. So I'm looking forward to sharing my thoughts on the effect of COVID on estate planning, valuations, and wealth transfers.
I'm having some trouble with the connection. Please try again in a moment.
All right, so thank you so much. The second speaker today is Andrew Runge. Andrew, good morning.
Good morning, Achille. I'm Andrew Runge. I run the forensic accounting, business valuation, litigation services practice for the firm. Hopefully today we'll provide some good information to assist anyone listening or anyone who may listen in the future in various thoughts you may have as far as doing wealth planning and protecting your assets going forward, especially in this new COVID-19 world.
Absolutely. Thank you so much. Just to finish introducing myself, I am the state chapter president of NACVA for Maryland and DC. I'm also the president and CEO of the Washington Valuation Group. And I also serve on the Valuation Credentialing Board of NACVA. So let's get right into it. There is an article that was published in Quick Read this week. I think it was on last Thursday. And I am the one who published that article. And the topic was about a new metric called EBITDA. And so my question to both of you is, I hope you had a chance to read the article, and I want to know a little bit of your views on that article. So where do you stand? Do you agree that, like other people, some people say that we should be using that metric, or do you disagree? And why, if possible? So who goes first?
Achille, I'll volunteer to go first. Your article set forth the fact that going forward, valuations of businesses are going to have to take COVID into account. I don't think you were emphatic enough. We haven't had something in this country like this in 102 years. So this is not something that will arise in the 5-year history of a business or longer. I say 5 years because that's generally what valuators look at. I think for 5 years after this pandemic runs its course and comes to an end, during this period of 5+ years, we're going to have to do adjustments to take into account the many businesses whose earnings and revenues were hurt, and the smaller number of businesses such as liquor, beer and wine stores, tech companies, internet mail order places that benefited during the period of COVID.
Thank you. Andrew?
Well, for the benefit, EBITDA is earnings before interest, taxes, depreciation, and amortization. And the C part, which Achille was referring to, is the coronavirus effect.
Mm-hmm.
And as valuators, we rarely agree on anything. And if you get 10 opinions, you're going to get generally 10 different opinions. I've spoken to some of my colleagues, and some of them kind of dismiss this with a shrug and say, well, if it's an ongoing business, it's an ongoing business, and this is just a blip, and I'm not really going to do that much about it. My position is, one, you need to look at the individual business, and I think each business is going to be impacted in a different way.
Mm-hmm.
Additionally, there's a couple other things which I think are important, and one is, what does that do to the industry as a whole, to the economy as a whole? And the other issue is, what does that do to your risk factors? Because typically, the riskier something is, the greater the rate of return which is required. So even if you assume that the business may do something similar, have the risk profiles changed enough that even if they're doing something similar, the value may go down.
And one thing that valuators consider is how likely is it to sell, and it may affect the lack of marketability discount that is often taken at the end of a valuation. Not going to be many buyers for restaurants and bars at this point.
Mm-hmm. Mm-hmm.
Or if they are, they're buying them at liquidation prices.
Yeah. All right. Well, thank you, guys. Thank you so much. So let's go to the second question. And by the way, I want to let the participants know that they can send us their questions if they have, and we find a way to ask those questions to the panelists today. Thank you. Second question. How has COVID-19 affected the market values of private businesses? What additional steps are being used to assess the uncertainty in the market, and how are those being addressed in valuation reports?
Andrew, you want to start this time?
I'll jump in on this one. It's my thought that if we're finding truly comparable companies, if you're trying to use pre-virus comparables or pre-virus metrics, I think you really got to look at those hard to make sure that those are really still comparable.
Mm-hmm.
And you may need to make some adjustments, or you may need to choose a different method, because the multiples that somebody was paying for a restaurant on January 1st of this year are certainly different than what they're paying now, or what they may be paying 3 months from now.
So if you can't use the market as shown in comparables, and looking at capitalizing prior earnings is risky, at least for earnings during the COVID period, I'm thinking that most businesses are going to be best valued by working with the owners, doing projections, and discounting the future cash flow to a present value.
I think you're right that we're going to see a lot more future discounted cash flow calculations, and also looking a lot harder at the adjusted net asset method rather than going back and doing a capitalization of prior earnings.
Mm-hmm.
But the issue you always get into is how good are the projections from the owner or whoever you're working with? How reasonable are they? How likely are they to be achieved? And then do we need to do a separate factor for how far they could be off?
I think owners that need a valuation for in order to transfer the business for estate purposes, if one is going through a marital termination, valuations are going to be more expensive, because we're going to have to think a lot more about what happened during 2020 and perhaps 2021, and how do we adjust for it on the in the valuation.
I would agree with that. And I think you're going to have a lot more battles on both sides because the experts now have 1 or 2 or 3 or 15 more things to disagree about, and you have to document it.
Yeah. But how do we reconcile the fact that because businesses are going through difficult times, they may not be able to pay the required fee that that's needed in order for us to do our job? So what's your suggestion on that in terms of issues with fees?
Oh, I think that if anyone needs to have an idea as to value and can't afford a valuation, that I think credentialed valuators are going to need to talk in general terms and perhaps express value as a range. And I think that's very, very important, even when a valuation is done to completion. If I had to value a restaurant as of June 30, 2020, I'm not sure I could give a single number. There's going to be one number if the pandemic winds down this fall, and another number if the pandemic carries through 2021 and hopefully not beyond. So I think we're going to have to often express as a range, and certainly when one looks at a business's books and financials, and the owner doesn't want a full valuation, all they're going to do is get a verbal, I think, with a high low.
Well, one of the other questions is, how are you going to factor in, let's say we have a restaurant. So if you're one of the survivors, you may have 30 to 40% of your competitors not reopen. So does that benefit you when everything does reopen? Are you going to have a big tailwind or a windfall from that?
That is very true coming out of any recession, and certainly coming out of this. If you look at history, the survivors often do extremely well. Good point.
Yeah, let's hope so. All right, so what's third question? In leasing and commercial real estate, is there an anticipated decline in long-term activity and or renewals? How will those declines impact the valuation of commercial real properties?
My reaction is that commercial properties risk going down in value. A lot of people, a lot of businesses that wouldn't have believed this in early March of 2020 have functioned very well remotely. And businesses, I think, are going to think twice before they take large amounts of square footage. I think it'll have a chilling effect on the commercial real estate market.
I would agree. I think you not only have the people that don't need as much space, but the bricks and mortar and retail stores, how many of those are just not going to reopen? And if they don't reopen, how are you going to find a replacement tenant? One of the large Nordstrom just came back and said they don't plan on paying more than half their base rent for the remainder of the year.
Mm-hmm. Mm-hmm. Wow. So you think most businesses are going to be going virtual now? And if so, that would necessarily reduce the impact of the lease or the expenses on the bottom line. So that could help increase the value of those companies. Is that right?
Well, theoretically, the operating companies, I think what's going to happen is as leases renew and as companies decide how much space they really need, even if their head count doesn't change, I think they're going to make a determination that they need 25, 50% less space. So as leases, renew, I think you're going to see more and more space come available. Less rates for the real estate market.
All right. Okay, so question number 4. What possible changes in ordinary income and capital gains rates do you foresee?
I think it depends on what, if the Democrats take total control of both houses of Congress and the White House. I was looking at the major tax legislation that we've had in the first year or two of a change in administrations, and I believe in each case the incoming party controlled both houses of Congress. We had major legislation in 1981, the first year of the Reagan administration. We had major tax legislation in 93 or 94 when Bill Clinton became president. 2001 was huge legislation, the first year of the George W. Bush administration. 2009, of course, under President Obama. In 2017, biggest legislation perhaps in 40 years in the first year of the Trump administration. If we have a Democratic president and both houses of Congress are Democratic controlled, I think it's a near certainty that we will have 1 or 2 higher tax brackets than the maximum 37% today, with a higher bracket starting perhaps at $750,000 to $1 million of taxable income, and then perhaps an additional bracket for those who make the highest amounts of income, or they may do it for political reasons as a temporary surcharge. Capital gain, I believe the Democrats support a higher capital gain rate. It was 28% for many years, and it would not be surprising to see it go to a higher rate, particularly with all of the expenses associated with COVID. We've got to expect that there will be a legislation that increases taxes. And if there is a Democratic president, because of Mr. Biden's age, it's possible that he only intends to be a one-term president, which makes him freer at raising taxes than if it were someone expecting to be in the White House for 8 years.
That sounds right. That sounds right. Andrew?
I would agree with all that. If all 3 branches end up in Democrat hands, tax rates are going to go up. How high they're going to go, I think that's debatable. I tend to think they're going to go higher, maybe even than David does. I think the capital gains rate's going back to 28, and realistically, I think it's going higher than that, maybe to 35 or 40%. The one thing that will benefit the high tax states, though, is I think they will restore the SALT deduction, the state and local tax deduction.
Yeah.
Okay. So you both believe that we may have a new legislation with some tax hikes, as long as we have Democrats taking over Congress. So there's a likelihood that those taxes will go up. Is that right?
Depending on who wins. If President Trump wins re-election, or if the Republicans retain control of the Senate, then muted, and you're going to kind of end up in sort of a status quo.
Right.
At least for 2 years.
Mm-hmm. All right. Question number 5. What's your perspective on possible estate freezes as well as changes to federal and state estate tax exemptions.
Well, I'll do that one. If the rates are going to go up, that makes the freezes more attractive. And the other issue is I think, again, similar to the last question, if the Democrats win the presidency in both houses, I think the estate rules are going to change and the exemption numbers are going to go down. So instead of where they are now, they're going to go down probably by several $1 million, if not more.
Yeah, I agree. The estate tax exemption, which is now getting close to $12 million, scheduled to be cut in half in 2026. It is a certainty in my mind that it will be cut at least in half in a Biden administration, and a number of Democrats would like to see the federal exemption go to 3.5 million, where it was for a number of years when President Obama was in the White House. States will need revenue. Maryland and DC have exemptions 5 million and 5.68 million respectively. They could possibly be cut. I know DC is talking about it. Virginia has not had a state estate tax in many years.
Okay. So I'm still looking on my screen to see if there's anyone that has any questions. I don't see any questions so far. All right, so let's go to our sixth question today. How can depressed valuations be used to maximize estate planning?
Well, everything is timing, so that you know, if your value of your company now has declined, and you can make a transfer now at a depressed value, that certainly helps you, especially if you think the value is going to increase in the future. But you know, everything is as they say, always risky, because it could be that you make a decision now and things continue to go bad and values decline further. But in the short term, if you think your company is going to rebound a year from now, 2 years from now, taking advantage of the excess risk and the excess worries about economic recovery, I think lets you make transfers at a lower rate than you otherwise would have.
Yeah, there's several specific techniques that can be utilized. Prior to 1990, in the case of a corporation, the most favored technique was having the owners, the senior generation, convert their common stock to preferred stock, and the younger generation gets the enhanced value. The law changed 30 years ago to really put a halt to that technique. But some of the other techniques involving a grantor retained annuity trust or a sale to an intentionally defective grantor trust, all of these techniques with low interest rates allow for a reduced valuation, and this is with an optimum time for wealth planning to consider these sophisticated techniques. And there's a simpler one that I like in the case of a limited liability company, and that is to bring the next generation in and have them share in income going forward, but the existing senior generation has the existing capital, and eventually they're bought out, for their interest in capital, but going forward, we have new people sharing in income, and essentially that accomplishes an estate of threes. So there are lots of techniques that are available, and as long as interest rates stay low, all of these will work in many circumstances.
All right, thank you, Dave. David. I got two questions from the audience. The first one is from Smita Patel. The question is, can you please summarize Nelson versus Commissioner as it relates to valuations made for 2019 gifting and member interest in businesses and gifted to trust? It's called the 2019 gift tax returns have been extended.
I'm not sure I grasped the whole question. Did you catch it, Andrea?
No, I mean, I haven't looked at the particulars of the case. I don't know if you have any thoughts on that from a legal perspective.
I missed the case
question,
tax scenario.
Okay, it says, can you please summarize Nelson versus Commissioner as it relates to valuations made for 2019 gifting of member interest in businesses and gifted to trust?
I'd have to take a look at the case. Don't recognize a lot of cases by name. We've got a couple of recent cases, Kress and Jones last year, that I immediately recognized by name, but you take me before 2019, except for cases that reached the Supreme Court. I don't always remember them. I'll be glad to talk to you offline if you would like.
All right. So, Mr. Patel, we're going to keep in touch. Yes.
Miss Patel.
Oh, it's Miss Patel, I'm sorry.
Miss Patel.
All right. So second question, do you have a take on that, Andrew? On this question or Miss Patel's question? No?
No, I'd have to go back and look at the particulars of the case as it relates to the question. After a while, they all start to run together.
Right. Okay. The second question is mostly a comment from Edward Bodnick. It seems to me that rates must go up with all the stimulus money and reduced tax receipts due to the down economy and the need. I'm not quite sure. He didn't finish his question or not.
I think he's espousing that interest rates figure to go up in the future, and they can't come down any further than they are now. The question is not if, but when do rates go back up? And I'm sure that the Fed wants to keep interest rates down as long as it can to stimulate the economy. But just like many people are of the view that you can't keep people in their homes indefinitely, it's the same principle. You can't keep interest rates artificially low on an indefinite basis.
My thought with that is since the first stimulus package in the Obama presidency back in 2009, people have been waiting for the rates to skyrocket, or at least go up significantly from where they are. And we're 12 years down the road, and that still hasn't happened. At some point, you would think it has to happen because they can't go lower. And with the amount of money that's being pumped into the economy, it stands to reason they have to increase, but thus far that just hasn't been the case. So I'm not sure that any of us can time when these interest rates are going to go up. And if we could all certainly make a whole lot of money.
All right. All right, gentlemen, thank you for that, for answering Mr. Bornick's question. So question number 7 on my list here, we talk about retirement plans. I want us to discuss The temporary ability to borrow or receive greater distributions from retirement plans, the conversion of traditional IRA to Roth IRA, and the minimum distribution from retirement plan and IRA now starting after age 72. What's your take on those?
Well, you brought up 3 points, Achille. I'll take the first point, and that dealt with the changes in the CARE Act, and they are very temporary. The CARES Act, enacted in very late March of this year, allows until the end of 2020 individuals to take up to $100,000 from their qualified retirement plan, basically an employer retirement plan, or their IRA, and if they put it back within 3 years, they do not pay taxes on it. If they cannot put it back, they get to spread the income over 3 years, 2020 through 2022. And there's also the ability to borrow up to $100,000. That borrowing ability, the norm is 50% of your vested interest up to $50,000 until September 22nd of this year. You have the ability to borrow 100% of your vested interest up to $100,000. Now, to be eligible for either of these, you must show that you were hurt as the result of the coronavirus. The statute appeared to be somewhat narrow. You or your spouse or a dependent had to have been diagnosed with the virus, or you must have been unable to work due to quarantine, furlough, closing, or reduced hours. However, IRS came out several weeks ago with notice 2020-50, and it includes circumstances such as when you're offered a job but you're not able to start, and another example where you have a reduction in pay, you qualify. So again, to reiterate, the added loan provision is only till September 22. The distribution without penalty, if you're under age 59 and a half and want to put it back, you have till the end of 2020.
Very good. Andrew?
Yeah, I think the virus may change some people's thinking as to how long they're going to work, and they may decide to work longer in order to reach certain milestones and maximize their Social Security payouts. I think that kind of goes on an individual basis. I saw one question here where somebody was going back to our commercial real estate question.
Right.
And they wanted to know if we think judges are going to let the tenants off the hook for the contractual rents. And I think that may kind of come down to a case by case, or maybe even a state by state basis.
Okay.
On that, David?
Yeah, I'm a little more pessimistic about judges letting tenants off the hook because they have to apply the law. But we've already seen our clients in negotiations with landlord get concessions. If they have years to go on a lease, it doesn't make sense to wipe them out. It makes sense to tack the unpaid rent in some of the later years on the lease, or to require personal liability on the delayed or forgiven payments if there was no personal liability on the lease as originally written. Achille, you also brought up a couple of other points on retirement plans.
Mm-hmm.
And this year, no minimum distributions are required from retirement plans where otherwise you would be forced to take something out at age 72. And note that age 72 is new. It was always age 70 and a half for people who did not hit 70 and a half by December 31 of 2019. The minimum distributions will normally commence at age 72, meaning the April 1 following the year in which you turn age 72. It's in essence a 3-month grace period. Your second distribution, if you take advantage of that grace period, will be required by the end of the calendar year in which you turn 73.
Okay. I have a question from...
So let me add one thing.
Okay.
If you continue to work,
Mm-hmm.
you are permitted to delay taking from that employer's retirement plan until you cease employment. And that does not apply if you are a 5% or more owner in your business. So one excellent planning technique, I've used it at least several times in recent memory, is you have to do this before the December 31 of the year preceding when you will turn age 72. You cut your ownership to below 5% in order to delay distributions and let your wealth build.
That's very good to know, David, because there are so many changes. Some people may not be aware. Andrew, you want to add anything to that question?
No, ultimately, it's like everything else. You have to have a game plan, and you have to plan because you can't do it at the last minute. Like David's last strategy, you have to be thinking ahead. It's too late once you've already hit the milestone.
Okay. I have a question from Jeffrey Rosenblum here. With the anticipated reduction in the estate tax exemption, do you think it's a good idea to make gifts before the election and use the exemption now?
I will jump on that because that is advice that we have been giving to our wealthier clients for some time. And we have to speculate what will be the effective date of a reduced exemption. Before I get to that, it's very important that IRS has indicated that when there is the scheduled rollback of the higher exemption, when it's scheduled to be cut by 50% in 2026, that gifts that were made in the years of the higher exemption will stand and will not hurt you going forward. In other words, it will be charged against that higher exemption and will not hurt you if there is a lower one. Presumably, if we move to a lower exemption before 2026, IRS will take the same position. Those who have significant wealth, and I'm talking people who have more wealth than they will ever be able to utilize in their lifetime, should consider making gifts to next generation prior to election day. They are probably safe until December 31. But sometimes you see legislation that is retroactive, and that's capable of constitutional challenges. It's retroactive to stop people from making last minute decisions. So if you want to be certain that you won't be caught up in a lower exemption, I would say complete the transfer by the day before election day. You have some degree of risk if you wait and see what the results are and do it by December 31 of this year.
Andrew?
That's something that I think we both agree on. I'm giving the same advice, is that if you have the funds, make the gifts before the election. I think David's right that there is some risk attached if you're making it between election day and the end of the year. But if you do it before the election day, I think you're probably safe, and you probably will not be hurt if they change the amount and reduce it. But you know, we're already at July 15th, July 16th. You know, there's only a few months before election day. So if you're going to do it, you need to start now so that you can do it and have everything in order.
All right. Okay, so our next question, it's 10:45, got 15 minutes left. So will we see more goodwill and other asset impairment in the foreseeable future? What are the pros and cons for asset impairment?
I think you're by the very nature of the risks that are involved in the change in the climate, I think you almost have to see more goodwill impairment. And some of these companies are going to take you know, significant write-offs in current earnings to reflect that. That's you know, that's going to be another problem, you know, to deal with, and it's going to be something else that we're going to have to think about. And alluding back to David's earlier comments, it's going to take longer to do these things, and it's going to cost more.
Yeah, we're back to higher cost. Yeah, David?
Nothing really to add. If any asset is on the books that has declined in value as the result of COVID, it needs to be written down for financial purposes. And I think we're going to have more write-downs in 2020 financials than we have in the past.
That makes sense. That makes sense. Okay, question number 9. How important are financial powers of attorney and medical directives today?
Well, it's an important part of our clients' estate planning, are powers of attorney and medical directives along with their wills. Medical directives, I think it's obvious that many, if not most people, want their wishes carried out. And for those who have an extremely serious case of COVID, it's useful to family and physicians that their wishes are set forth in writing. Financial powers of attorney allow avoiding a spouse or next of kin during the disability of someone. It avoids them having to go into court and be appointed guardian of their property. It's a good idea for most people, especially as we get older, to have a financial power of attorney with at least one backup to allow someone you trust to act for you if you're disabled and have an inability to sign or to otherwise communicate.
So our power of attorney, just to piggyback on what you just said, are they better, like, for lack of a better word, are they better than having a trust? I'm trying to figure out what the right word here. So what do you think between the power of attorney and a trust? What would you recommend?
They are really two different things, but people who have chosen, it's actually a very good question, people who've chosen to use a living trust rather than a will as their dispositive instrument, and it's beyond the scope of today's presentation to debate which is best, other than for me to say you have to look at the particular facts. But even people who have a revocable trust should still have a power of attorney. In particular, they may find it easier to deal with banks and brokerage firms, and power of attorney will cover things beyond what can be done in a revocable or living trust.
Andrew?
So, David, a question which comes up, and I'll ask you as an attorney. So, does a power of attorney extend past the date of deceasement?
I missed a word. Does it extend past the date of?
Deceasement.
No. A power of attorney stops on death in every jurisdiction that I'm aware, and then at that point, you're guided by the will, a personal representative or executor gets appointed, or many assets, if you've used the living trust, the successor trustee can act. But a power of attorney stops at death. There are a couple of different types. There are those that are effective upon signing, and there are those that are effective only in the event of disability. All three local jurisdictions permit either type. Note that Florida does not permit powers of attorney that are not effective on signing.
Because I'll have the question come to me is that people think that they have power of attorney, and then when their loved one passes, that continues, and then they can just use the power of attorney, which predated the date of death, to set up an estate or do all these other things, and then they're surprised to find out that's not the case.
Right. I see that all the time.
Absolutely. All right, next question. The IRS recently changed the review requirements of appraisals. What are your thoughts about the potential effect? What steps should appraisers take to mitigate challenges to clients' returns and avoid penalties?
Well, I'll start with this one. The IRS keeps adding to the list of what they want valuation professionals to do, and they drive up the cost. They also keep adding on to our potential liability in the event they don't like something that we determined, or if they disagree with us. And again, if you now have a civil liability to the IRS for any work you do, again, it drives up the cost. Ultimately, I think there is going to be enough coming out of the COVID that probably the IRS and the AICPA and the NACVA and the ABV are probably going to talk about some other requirements related to what they think are going to be required in the standards. But I guess we'll see. And we tend to be reactive versus proactive. So who knows when that might happen.
Two pieces of advice here, Achille.
Yes, go ahead.
One is, if you need an appraisal, whether it's a business or a piece of property or for a conservation easement, which have really been challenged by IRS, number one, use a reputable appraiser or valuator, one who's respected. And number two, always remember the principle. If it doesn't smell right, there's probably something wrong with it. It's spoiled, and that applies to valuations and appraisals that are likely to be challenged by IRS.
But what is the IRS looking for then? If they keep changing those requirements and putting appraisers, you know, in difficult times, in difficult situations, what is it that they're looking for? Is it that the reports that they're getting are not being done properly from valuation experts, or is it because they are trying to find a way to I don't know, get more revenue? Or I don't understand.
A lot of them that are being submitted are not following the rules that are set forth, even in the instructions on the form. IRS wants sufficient detail of what was given. They want to know the condition of the property, the usual market of value of the property, the detailed terms of any contract. And if you don't give enough information, you're likely to be scrutinized. In some situations on tax returns, people want to over-describe something unusual. But in the case of a valuation that must be attached to an income tax return or an estate tax return, detail, extreme detail, very important.
Thank you. So let's go to our last question. We are 5 minutes away to the end of this webinar. So I want you to share with the audience your any comments about recent tax court rulings, specifically regarding the one that permitted a 35% discount.
I guess I'll start because I mentioned two key cases earlier in the presentation. Kress versus United States, a case out of Wisconsin, and perhaps the more significant, Estate of Jones versus Commissioner, a tax court case in 2019, where the court permitted a 35% discounting on gifts. In the Kress case, it was 25 to 27%. Now, every case is fact intensive, and as Andrew mentioned, particularly in valuation, reasonable minds can disagree. But the two cases, and particularly Jones, show a couple of things. Number one, the court said that you tax affect all entities, even flow through entities, to take into account you will be paying tax at some level. And I think the case also showed, excuse me, that the trend is toward the court accepting larger discounts. In recent years, the typical discount, although no two sets of facts are similar, that IRS would accept under audit at least, was about 25% in the case of minority interests. And I think Jones sets the stage for discounting at a higher percent. Now, the valuation community is really only about 25 to 30 years old at this point. And the studies that are being done that used to suggest larger discounts than that, newer studies are suggesting smaller, and the courts are accepting them in that 25 to 35% range, depending on facts.
Andrew?
Yeah, I think both cases that David mentioned are good ones. In particular, prior to the court accepting tax affecting, the IRS was taking a pretty strong stance that they did not want to see tax affecting done to pass through entities. But the economic reality is that someone somewhere along the way is paying tax on that money, And to arbitrarily say that a pass-through entity should not tax effect, I think was just wrong. But, you know, there were ways to kind of get around that, dealing with cash flow and other issues. But ultimately, the tax affecting issue, I think, is going our way. As far as the size of discounts, you know, any number of different ways to try to estimate what the discount for lack of marketability or lack of liquidity is. You know, unfortunately, they're not all apples to apples. Some are apples to oranges, and you're looking at that for guidance. And you know, and then you have you know, Dr. Bajaj, who's coming up with discounts of 4 or 5%. Fortunately, the courts have been not been looking favorably at his 4 to 5%, and they've actually been getting bigger. Mm-hmm. But that's still, I think, going to be an area which is going to be ripe for litigation, and hopefully we'll come to some sort of reasonable accommodation as to what our reasonable range is, again, which are fact specific. But I don't think the IRS in general is going to win with 4 or 5%, and I don't think very aggressive valuators are going to win with an 80% discount. They're both outliers.
Absolutely, outliers. All right, well, gentlemen, thank you so much. This is the end of this conversation. I want you to give us your final thoughts about this topic. So who goes first?
Glad to go first.
Okay, sure.
Just conclude with that the years that follow COVID are going to be years of recovery. It's going to be very, very challenging, not only for businesses, but also for the people who have to value those businesses.
Thank you, David.
Just one, to thank David for his time and his insights. I'd also like to thank you, Achille, for being a part of this and for moderating. And if anyone has any questions which they would like further input on, I think you have our my contact information, as well as for Achille and David, and we would certainly be happy to respond to any questions that you have.
Well, thank you so much, everybody, for attending this conversation, and have a good day. Thank you.